Hi traders, good morning, good afternoon, good evening. I hope all of you are doing good. It's a beautiful Sunday, and today we are going to learn some basic principles of reading charts. So, I want to teach you, like for all the beginners, how do you read a candlestick chart and how do you identify trend and what are the things which you need to have on your chart setup. Few basic things, like we are going to use a 20 period moving average and a 200 period moving average and a candlestick chart. By using only these three things you will be able to identify the trend of any stock or an index. So without wasting much of a time, let's get started and let me take you to the charts. So yes, traders, so we are on this bank nifty chart. So let me show you what kind of chart patterns we have on any kind of software you take for technical analysis. So here you can see this depicts the candlestick chart. So if I click on this, so there are charts which is called as bar chart. Bar chart will look something like this. Halo candles, something like this, and then Heikin-Ashi. So each chart is different and the way you have to use the chart is very different. So this is a line chart and there is an area chart and there is a baseline chart. So but most of the traders prefer doing candlesticks and also Heikin-Ashi, because if you are a trend trader you can use Heikin-Ashi candles. So candlesticks were actually invented by Japanese, and you can Google the history of that. But today I am going to make you understand a simple explanation of how to read the candlestick pattern. Now, yeah. So if you see, this is basic candlestick structure, and we have a red bar and a green bar. So I will show you the examples on the live chart as well. So first we need to understand some basic points. So this candlestick is formed basis the price. So whatever candlestick patterns or any chart pattern you take, everything follows price. Even any indicator you take, that follows price as its base for any kind of future prediction. So let us understand what each of them signify. So if you see, there are four components to any candlestick. One is open, close, low and high. Open is the price at which, see, if you are using a 5-minute candle, then a 5-minute candle opened at this price, and after 5 minutes, end of 5 minutes, it closed at this price, and during the 5 minutes it has created a low and a high. For example, it opened at 100, it closed at 80, it made a low of about 60, and it made a high about 120. So 120 is your high, 60 is your low, opened at 100, closed at 80. So since it opened above and closed below, the candle color will be red. So this is a bearish candle because the price moved downward. I hope this is clear. And these are the highs and lows form, that's why they are all depicted by wicks. So the same logic applies to a green candle also. The price opened here, say 100, it closed at say 140, it created a high of about 160, it created a low about 80. So what is the color of the candle? It's green because it opened low and closed higher. So there is a lot of buying power. That means bulls have won on this. here bears have won. So you can see bearish and bullish. So these are the only two candlestick types which you will be able to see. These are the basics. These two, every chart you take, these are the two things which you are going to take. Time frames can differ. Either it can be 1 hour, 5 minutes, 15 minutes, 3 minutes, 1 minute. Everything is possible basis this candlestick. So let us understand this going on to a chart. Okay, so let me draw some more patterns for you. You can always see a candle which is full green or a candle which is full red or a candle which has like 50% body. It can be red or it can be green. Okay, so you can always see that these are the main patterns. Either this can be full green, full red or 0.5%. So just keep this in the mind when we go to the live chart. Okay, so now what do you see? The first thing what we have learned is that this is a full green candle. That means too much of buying power, right? This is also full green, full green. Here you can see a 50% body candle. This is a full candle. This is a full red candle. So always try to identify. See, this is again less than 50%. And what do we call these candles which are less than 50% or equal to 50%? We call them as base candles. Why we call them as base candles? Because here both bears and bulls are fighting and creating a base, and there is a fight going on at this level and nobody has won. Within the next candle, bulls have won. That's why they have taken the price up from here. Right, so that is the concept. So keep that in mind to analyze any chart. So if we look at monthly chart and let's look at this candle which is forming for the month of January, you can easily say that bears are winning because the body of the candle is very small. It's less than 50% and entire selling pressure is coming from the top because this has reached to a level where it has peaked in the past. So this was the peak before Corona. So we have reached there, and from the same level again selling pressure is coming. So no wonder even if this candle closes like this month, you can expect. But you always need to look at volume also. The volume has to be high if this kind of candle is forming. So now we can see this, that is in downtrend. Let's go to a weekly chart. See, you will find a lot of patterns on the internet where they say engulfing, harami, and all those different patterns which are there. But understand this concept. The basic concept is like there will be a full green candle whose body is like more than 50%, and there are candles which are body less than 50%. So they called as leg candles. Whichever color they can be a green color or red color, and the candles which are 50%, they are called as base candles. So chart is comprises of these two things only, and I'll tell you how to identify the reversal. So whenever you see, now let's come back to our two key moving average what we are going to use, which is 20 and 200. Okay, these two things are enough for you to identify any trend. Stock trending above 20 period moving average, simple moving average, is in uptrend. Okay, above 20, uptrend. Okay, so this is an uptrend. Price above 20 and above 200, it's an uptrend. On any retracement, you can buy. Same, stock below 20 and below 200, it's in downtrend. On any pullback, you can sell. Keep this thing in the mind. Okay, so I have plotted Bank Nifty chart here. Let me show you the plotting and just remove all the studies. And just try to put simple moving averages. This I'll put 200, let the color be red. This I will put 20, let the color be green. Okay, clear? So rule number 1, that this is price below 20, price below 200. Whenever it retraces, you have shorting opportunity. Retracement, shorting opportunity. Retracement, shorting opportunity. So whenever price is moving downtrend fast, it always retraces from 20. And when can you expect the trend change to happen? When the price starts to hold the 20 period moving average, because it will start coming up on this and it will start holding this. So you can expect this to go till this level. And if it fails from there, then again it's a shorting opportunity. Otherwise, if this breaks out, then the breakout is happened and the stock changed its complete trend. So this is on a 5-minute time frame. Now you can see the uptrend also. The stock was holding the 20, right? It started moving up. It crossed the 20 and then it came for the retracement and it was holding 20 and moving up. So whenever there is a fall onto the 20 period moving average from this level, it's a buy. This was a buy, but later this changed. The trend changed here and market went into sideways for some time. But still it went up. So there are various ways you can use a trend line also to understand like where are we heading to. This is a 5-minute chart. Okay, I would always advise you to do this on a higher time frame and understand what is the overall trend of the market and then make your analysis. So this is your trend line. Okay, so market was an uptrend and it's still an uptrend. You can further expect the market to actually come down to this level and then form a new high because it is trending. It is going up, taking retracement, going up, taking retracement, going up. So there is always a higher high and lower high, higher high. So this is an uptrend, you can see. If the trend changes, then you will find a breakout below this level and then it will start going down, making a high, going down, making a high, going down, making a lower high. It will be lower lows and lower highs, LH, LL. Like this. So try to understand what price is doing and where is the price, and there are various concepts to it. The more deeper you get into this subject, you will understand a lot of things, but I would suggest always keep it simple and try to practice the same thing every time and have simple rules of exit and entry. So even if you're a long-term trader, what you need to do is, for example, if you are a swing trader and you are expecting an entry when the price crosses 20 period moving average, you can definitely enter here. Keep your stop loss below this candle or below this swing as a safety, and the price started moving up, holding the 20 period moving average. You could have exited here because it broke the 20 period moving average. Again took an entry here and again exit here. So simple rule you can follow. Don't clutter your chart with lot of indicators, lot of moving averages. This is enough for you, 20 and 200. And if you don't want to use moving average, you can always use the super trend. Even that setup is also very simple for you to understand. So don't complicate it too much. A lot of people don't even use the moving averages, but I would suggest moving averages gives you the depth of the market and understand where is the market moving. Let's analyze some more stocks on this particular setup and see if we can change. So let's see, for example, if you want to see Kotak Bank. Okay, this is Kotak Bank chart. This is on a daily time frame. You have got an entry here. So this is entry point. Stop loss would have been here. You have invested amount, and then you can see the ride. Let's look at Grasim. You will be surprised to see the movement Grasim has given. After this crossover, see the way it has gone up. Still holding on to the 20 period moving average. Let's look at some other stock. For example, Tata LXI. See this? The kind of move it has given after this crossover. Still holding 20. Maybe you could have exited here with this candle or entered again after this candle, and then. So I am explaining this to you in a very basic form today. And if you go back to my videos after understanding this, you will be able to understand the whole concept much better, because I have added a lot of things like patterns to this, where you have to enter and where you have to exit. All these patterns I have shown in my videos, and where you have to add, exit. So like this. So go back to the videos and you can check how this can be done. Once you identify the trend, there are various ways we can trade. We can either trade in futures, we can trade in options, we can trade in cash, whatever is comfortable for you. I usually trade in options, and that too only in Bank Nifty, and I create positions basis the market behavior. So right now in Bank Nifty, as you can see, the trend has changed. So what is the position I'm holding? So this is a position which I'm holding. I have a position where I had created a butterfly initially, and market came into this, and immediately on the same day the market moved out of this butterfly. So I have created a position. I have added a call sell and a call buy, so that I am hedged completely if the market further goes down, and still I'll be in profit. This is the profit probability what we are having, 84%. Loss will be 12,000 even if the market opens somewhere here also. So but profit will be 15,000 if we stay in this zone. Okay, so this is how you have to play the market. You don't have to be right all the time, but you have to manage your risk properly and have a clear view where the market is heading. So my direction was down, so it was right. If the market changes the direction, I will close this position and then create a fresh position on the upside from here. So that's about it, guys. Don't complicate your trading too much. Don't over trade, in this word, that if you have made like 1,000 rupees in a day and you don't keep quiet, you go back and try to experiment something, and again you lose that amount and come out, which is bad. So always maintain your trading psychology has to be proper, and you should know how much you have to take from the market in a day and stop trading. So follow simple setup and try to trade in a simple fashion and make money, and become consistent first and keep logging your trades so that you get to know what have you done well and what is not working for you, so it becomes clear for you. Always follow a simple setup and trade with only that setup. Do not try to experiment further. Whenever you want to experiment, you will always end up making loss, because this market and knowledge about market is huge subject, and everybody will teach you a different kind of a concept. So if you are following one concept, I would suggest that you stick to that concept. Do not keep looking for new strategies and new concepts, because that is going to spoil your mind further and spoil your trading further. So this is my advice. Please do like the video if you have enjoyed it and learned something new, and give a thumbs up, and subscribe to the channel, share it with your friends. Thank you so much for watching.